67% of Americans say a housing crash is imminent in the next 3 years. With all the talk in the media lately and a lot of YouTube channels hyping a market crash, it is no wonder that people feel so confused about our real estate market. Just take a look at a few of these headlines from January. Goldman Sachs, 4 cities face 2008-sized crash in housing prices. And another one, Phoenix housing market crash could bring prices down 25%, report says. Now again, these articles just came out in January. And then in the first week of February, another article came out saying this. Goldman Sachs now sees peak to trough drop in US housing of 6% from 10% previously.
That's crazy.
When a financial giant like Goldman Sachs completely changes their perspective on the real estate market in a week, it can be confusing. And I know that people want to hold on to those headlines about a crash because those that got priced out of the market want nothing more than to see the prices come down significantly. And even though the Fed is doing everything that they can to decelerate the housing market to bring it back into balance, the current market is just not reacting the way they thought it would. And it's not just Goldman Sachs that has changed their perspective on the overall housing market in the last few months. Most economists have come out and changed their perspective, especially after the January that we just saw. So despite how 67% of Americans really believe that we are headed for a crash, the current market shows that today's market is nothing like it was before the housing crash of 2008. See, back then, mortgage standards were much less strict. During the lead up to the housing crisis, it was much easier to get a loan than it is today. Banks were creating artificial demand by lowering the standards required to actually get a loan. And this was making it easy for anybody to go out and get a loan or refinance the loan that they had. And as a result, lending institutions took on a much greater risk. That led to falling prices, foreclosures, and massive price declines. Today, things are much different. Buyers face much higher standards from lending companies. When you look at this chart from the Mortgage Bankers Association, it helps tell the story. In this index, the higher the number, the easier it is to get a mortgage. The lower the number, the harder it is. This chart also shows how different things are compared to the spike in credit availability leading up to the crash. Tighter lending standards have helped prevent a situation that could lead to a wave of foreclosures like it did last time. Another difference is the number of homeowners that were actually facing foreclosures when the housing bubble burst. Foreclosure activity has been lower since the crash in 2008, largely because buyers are much more qualified and much less likely to default on their loan. This chart from Adam Data shows the difference between last time to now. So even as foreclosures tick up, the number of foreclosures is still very low. On top of that, most experts believe we will not see foreclosures go up drastically like we did after the crash of 2008. Bill McBride, founder of the Calculated Risk, said this. The bottom line is there will be an increase in foreclosures over the next year from record lows, but there will not be a huge wave of distressed sales as happened following the housing bubble. The distressed sales during the housing bust led to cascading price declines, and that will not happen this time. And Molly Boisel, chief economist of CoreLogic, said this. The wild ride known as the U.S. housing market slowed dramatically in the fall of 2022 as mortgage rates surged and home prices remained high. Home sales started strong in early 2022, but took a nosedive later that year. On the plus side, generous amounts of home equity will protect many borrowers from experiencing the type of foreclosure activity seen during the Great Recession. Here in the Phoenix market, we were one of those markets that saw a huge wave of foreclosures come into our market after the crash of 2008. So it would make sense for those people that went through it last time to feel as if the same thing was going to happen all over again. But here is a chart that will show you what our current foreclosure situation looks like. We are not seeing a spike in foreclosures, and for all the reasons we're talking about, we do not foresee anything like this coming. Now it comes to the supply, and this has a big impact on the market. During the 2008 housing crisis, there were too many homes on the market, most being short sales and foreclosures, and this caused prices to drop drastically. Builders had also overbuilt for the demand, which was artificial. Currently, many cities actually have a lack of inventory, and this continued lack of inventory makes perfect sense why many buyers feel they have to bid up prices to secure the homes that are on the market available. And this also indicates that our supply and demand equation simply won't allow prices to crash in the near future. Now, the inventory in Phoenix did begin to rise, but since October, it has been coming down. And currently, our inventory is below pre-pandemic levels. Now, this tight inventory will not completely negate any price declines in 2023. However, the lack of inventory coming to the market will prevent an overall housing crash. A Morgan Stanley researcher said this. Although supply doesn't keep home price growth floored at zero, we do believe it prevents home price declines from becoming too large. Supply here in the Phoenix market has been decreasing since October of 2022. Builders have slowed the number of permits that they're actually pulling, and currently there is a shortage of homes for sale. And this shortage has actually been going on since the housing crisis in 2008, when builders pulled back significantly. Now, the supply chain issues that we had during the pandemic did not help because builders could not build homes fast enough. And now that the demand has pulled back, builders are really putting a pause on the number of permits that they're pulling because they do not want to end up in the same situation that they were back in 2008. The fundamental reason for a run-up in prices is high demand and low supply, which is what we've been experiencing over the last few years. Currently, the interest rates are playing a huge role in the actual momentum and affordability of the overall housing market. So where do many experts believe home prices are headed? Rob Dietz, chief economist of the National Home Builders Association, said this: most markets are going to experience price declines in the high single digits. Home price declines of 8 to 9% would create some economic pain, to be sure, but this correction will be nothing like the utter collapse of property prices during the Great Recession, when some housing markets experienced a 50% cratering of values. This is what we saw in the Phoenix market. Now, as I said earlier, with all the negative headlines, and as my friend Christina Smallhorn calls them, the crash bros on YouTube continue putting out information about a housing crash, it is hard to see through all the noise, but I want to show you something. So these headlines are all the way back from 2015, all of them saying the market's crashing. Had you not bought, you would have lost out on all of the appreciation from 2015. But had you purchased a home in 2015 at $300,000, by 2021, you would have $223,000 of equity in your home. And this is why I am always saying that real estate is a long-term hold. I know it can be scary, I know it can be overwhelming, but I believe in home ownership. And it is a great way to grow your overall wealth. If you like this video, make sure you take a look at this one. If I can ever answer any questions for you, please feel free to reach out. As always, I thank you for watching, and I'll see you next time.